Hi everyone, I Dhriti at IndianFolk would like to discuss with you the rationale and implications of corporate tax cut on Indian economy. India and world at large are going through an economic slowdown. Automobile and real estate sectors are badly hit. GDP growth rate for the first quarter of fiscal year 2019-20 has been reported to be 5% lower in 6 years. In such economic crisis, Finance Minister Nirmala Sitharaman announced the biggest ever tax cut for corporate sector in 28 years, slashing the tax rate from 30% to 22%. For new manufacturing companies, the taxes have been slashed to 15%. On one hand, where the move has been hailed, on the other it has been heavily criticized. Where monetary policy aims at increasing money supply in the market, fiscal policy intends to raise aggregate output in the economy by raising government expenditure and reducing tax rates. In such cases, the government spends more than it earns as tax revenue. In current scenario, the tax cut is supposed to increase profit after tax deduction for the corporate sector so that they can invest that surplus fund and generate income with a multiplier effect. In the time when consumption undoubtedly is the root cause of slowdown, the government decided to go for boosting supply side by reducing corporate tax. This move is in line with the trend in developed nations such as USA and UK, where corporate tax rates are way below personal income tax rates to boost manufacturing and services sector. Income tax is paid by around 1% of people only since the tax base is not wide enough, whereas around 60% of direct tax revenue comes from corporate tax. It should also be noted that jobs are not created by reducing personal income tax but by cutting corporate tax rates. Changing GST tax slabs require consensus amongst all state governments in GST Council, which is a cumbersome task. Hence, the government went for slashing the corporate tax. Increasing in investment and reduction in tax leads to an increase in income at a multiplied rate. Sukanya Bose and N.R. Bhanumati estimated the value of tax multiplier around -1 in their research paper published in September 2013, Fiscal Multipliers for India. This implies that a tax cut of, let's say, 100 crore rupees will raise the level of GDP in the fiscal year by 100 crore rupees given both the figures are measured at nominal prices. The new tax rate brings India at par with other Southeast Asian countries such as Singapore, Vietnam, Thailand, Taiwan and Cambodia, which are India's biggest competitors in attracting foreign direct investment. Besides, 15% tax rate for new manufacturing units will act as a fillip for growth of manufacturing sector in India. The gap between tax paid by manufacturing and non-manufacturing companies had been widening till 2018, which will now narrow down a bit. In the first quarter of 2019-20, manufacturing sector registered growth of a mere 1% as compared to 12% in the same quarter last year. The tax cut will increase firms' profitability, which should eventually raise salaries and wages. Tata Steel, JSW Steel, Eicher Motors, ITC and Britannia are seen to be the biggest winners from this decision. Credit rating firm S&P Global termed it as a credit negative development due to concerns over rising fiscal deficit, but Moody Credit Rating Agency called it credit positive as the tax cut is expected to raise investment level, create new employment opportunities and increase national income. The tax cut is going to cost government around 1.45 lakh crore rupees, with the GDP growth rate falling to a 6-year low. Reduction in corporate tax cut will make it quite difficult to achieve the fiscal deficit target of 3.3% of GDP as set by Finance Minister for fiscal year 2020. For a developing economy, however, it is acceptable for the state to raise its expenditure while reducing its tax revenue to augment economic growth. This move only addresses the investment side but neglects the demand side of economics, which is necessary to solve the current crisis. It is highly contested that the tax cut will benefit consumers anytime soon. Hence, the time is right to appreciate honest taxpayers with a gift of lowered personal income tax. The focus of the government should be on reviving rural demand. For this, employment opportunities in rural sector need to be raised. Most importantly, the government should not decrease its spending income to compensate for the loss in revenue. To tackle the issue of fiscal deficit, government cannot rely on transfer of surplus funds from RBI. It should look towards raising non-tax revenue as well. It should engage in privatization of public sector units with full transfer of control. If and only if complemented with demand-side interventions, then can we expect the seeds of corporate tax cut to bear desired fruits. Thank you.